Stop right there. I know what you're thinking. Tax season feels like a lifetime away, but what if I told you that understanding the Earned Income Tax Credit, specifically the limits and tables for 2026 right now, could be the single most financially impactful thing you do for your future self? This isn't just about some obscure tax rule. This is about thousands of dollars that could be sitting on your table, money that is rightfully yours, money that could change your family's trajectory. And here's the reality. If you wait until tax season 2027 to start thinking about your 2026 taxes, you've already lost. You've already missed opportunities to optimize, to plan, to ensure you don't leave a single penny behind. I want to save you from that nightmare. I want to equip you with the knowledge to proactively claim what's yours. This isn't just a tax credit, it's a lifeline. A significant boost for low to moderate income working individuals and families. And it's a credit that is often misunderstood, often overlooked, and tragically, often unclaimed. Let me explain why this matters so urgently. The Earned Income Tax Credit, or EITC, isn't just a reduction in the tax you owe. For many, it's a refundable credit. That means if the credit amount is more than the tax you owe, you get the difference back as a refund. Imagine that. The government's sending you money, not just reducing your bill to zero. This isn't charity, it's an incentive for working, for contributing to the economy. It's designed to help you, the working American, keep more of your hard-earned money. But here's the catch, and it's a big one. To get this money, you have to understand the rules, the limits, and how those infamous tables work, especially as we look ahead to 2026. Now, you might be saying, 2026? That's so far away. Why worry about it now? And I get it, life is busy. But the EITC, like many tax provisions, is indexed for inflation. The specific income limits and the maximum credit amounts change slightly each year. While the IRS releases the official, final numbers for a given tax year much closer to that tax year, the structure of the EITC, the way it calculates, the way it phases in and phases out, and the types of income and family situations it applies to, remains consistent. Understanding this structure now allows you to make informed decisions throughout 2026. It allows you to plan your income, understand potential thresholds, and crucially, avoid common pitfalls that cost people thousands. This isn't just about filling out a form, it's about financial strategy. It's about knowing if that extra shift, that freelance gig, that side hustle, might push you over a limit or, conversely, make you eligible for a larger credit. So let's dive deep into these limits and tables for 2026. While exact dollar figures are always subject to slight adjustments based on inflation indexing by the IRS, we can project based on current trends and understand the mechanisms that will be in play. The EITC has several key components that determine your eligibility and the amount of credit you receive. First, you must have earned income. This isn't a benefit for those who aren't working, it's for those who are. This includes wages, salaries, tips, and self-employment income. But here's a common misconception. Some people think if they have any investment income, they're out. That's not entirely true. There's an investment income limit. For 2026, based on current indexing trends, this limit will likely be somewhere around 12 to 12 to AHA. If your investment income, which includes things like interest, dividends, capital gains, and certain rental income, exceeds that amount, you become ineligible. The why here is simple. The EITC is designed for working individuals and families whose primary income source is their labor, not their investments. So if you're a stock market whiz with significant passive income, this credit probably isn't for you. But for the vast majority of working Americans, this limit isn't an issue. Yet it's a hurdle that trips up some every year because they simply don't know it exists. Beyond earned income and investment income, your adjusted gross income, or AGI, is absolutely critical. This is where the limits really come into play. The EITC phases in, then it plateaus, and then it phases out. This is where the tables come in. Imagine a bell curve. At very low income levels, the credit increases as you earn more. This is the phase-in period. It's designed to encourage work. Then, for a range of incomes, the credit stays at its maximum. This is the plateau. Finally, as your income continues to rise, the credit gradually starts to decrease until it hits zero. This is the phase-out period. The exact points where these phases begin and end depend on two major factors: your filing status and, crucially, the number of qualifying children you have. Let's break down the impact of qualifying children. This is where the EITC can become truly transformative. The more qualifying children you have, up to 3, the higher the maximum credit you can receive, and the higher the income limits are before the credit phases out completely. For 2026, again, these are projections based on current law and inflation, but the magnitude of the difference is what you need to grasp. For a taxpayer with no qualifying children, the maximum credit is significantly lower, and the income limits are much, much tighter. For one qualifying child, the credit jumps substantially. For 2 children, it's even higher, and for 3 or more children, it reaches its peak. This is why accurately identifying and claiming your qualifying children is paramount. A qualifying child must meet several tests. Age generally under 19, or under 24 if a full-time student, or any age if permanently and totally disabled. Relationship: your son, daughter, stepchild, foster child, brother, sister, stepbrother, stepsister, half-brother, half-sister, or a descendant of any of them. Residency must have lived with you for more than half the year, and joint return cannot file a joint return unless it's only to claim a refund of withheld income tax or estimated tax paid. I know, it sounds like a lot, but missing just one of these details can invalidate your claim and lead to an audit, and I want to save you from that headache. Let's talk concrete scenarios for 2026. Imagine you are Sarah, a single mother with 2 qualifying children. For 2026, based on projections, the maximum EITC for someone like Sarah could be well over $6,000, maybe even approaching $7,000. Her income limits would be quite generous. She might be able to earn up to, say, $50,000 to $55,000 in adjusted gross income and still receive some credit, with the maximum credit hitting somewhere in the $20,000 to $25,000 AGI range. Now imagine Sarah works a full-time job at $18 an hour, bringing her annual income to around $37,440. If she has 2 children, she's likely right in that sweet spot where she's getting a substantial EITC. Her common mistake could be not reporting all her earned income accurately, or worse, not claiming one of her children because of some minor misunderstanding of the residency test. The consequence? She could lose thousands of dollars. The solution? Meticulous record keeping, understanding the qualifying child rules backward and forward, and not being afraid to ask for help from a reputable tax professional, or using free tax preparation services. Now consider Mark, a single, childless worker. For 2026, the EITC is available to him too, but the limits are much, much tighter. The maximum credit might only be around $600 to $700, and the income limits could be as low as $17,000 to $18,000. If Mark earns $20,000, he might be entirely phased out or receive a tiny fraction of the credit. His common misconception is often that the EITC is only for parents. He might not even bother checking his eligibility. The consequence? He leaves hundreds of dollars on the table, money that could have helped him pay a bill, fix his car, or simply make ends meet. The solution? Every working individual, regardless of dependence, should always check their EITC eligibility. The tables don't discriminate based on your family structure, only on your income and the number of dependents you have. What about a married couple filing jointly, like David and Maria, who have 3 qualifying children? This is where the EITC can be truly life-changing. For 2026, their maximum credit could exceed $7,000, and their income limits could be as high as $60,000 to $65,000 before the credit completely phases out. Imagine David works a steady job and Maria has a part-time gig, bringing their combined AGI to $45,000. They are likely eligible for a significant EITC. Their common mistake? One spouse might not accurately report their income, or they might misunderstand the married filing jointly requirement. Filing married filing separately almost always makes you ineligible for the EITC. This is a critical point that many married couples overlook. The consequence of getting this wrong could be an audit, delayed refund, or losing thousands of dollars they desperately need. The solution? Open communication about all income sources, ensuring they choose the correct filing status, and verifying that all 3 children meet every single qualifying child test. And let's not forget the growing segment of our workforce, the freelancers, the gig workers, the self-employed. Imagine Emily, a graphic designer who works as a freelancer. Her earned income for EITC purposes isn't just her gross receipts, it's her net earnings from self-employment after deducting her business expenses. This is where things get tricky. Emily needs to meticulously track her income and expenses to accurately calculate her Schedule C profit. If she overestimates her expenses, her net earnings might be too low, potentially reducing her EITC or making her ineligible if her net earnings fall below the minimum threshold required to initiate the credit. If she underestimates her expenses, her net earnings might be too high, pushing her into the phase-out range prematurely. Her common mistake? Poor bookkeeping, not understanding that her business income after expenses is what counts. The consequence? An incorrect EITC claim, potential IRS inquiries, and the stress of dealing with corrections. The solution? Investing in good accounting software, understanding what qualifies as a legitimate business expense, and consulting with a tax professional who specializes in self-employment income. The tables themselves are not something you typically see or interact with directly if you're using tax software or a tax preparer. They are algorithms, mathematical formulas that the IRS provides to calculate the exact credit amount based on your earned income, adjusted gross income, filing status, and number of qualifying children. The software or preparer plugs in your numbers and the table spits out your credit. But understanding how these tables work conceptually is empowering. It tells you that every dollar of earned income you make, up to a certain point, increases your credit. Then, every dollar of AGI you make, once you hit the phase-out range, decreases your credit. This knowledge allows you to strategically plan. Could taking on a little more work early in the year help you reach the maximum credit plateau? Could deferring some income or increasing pre-tax deductions late in the year keep your AGI below a critical phase-out threshold? These are the kinds of questions you can ask yourself now for 2026, rather than scrambling in March 2027. I know this feels like a lot. I know you're stressed about taxes, about money, about making ends meet. But please, do not fall into the trap of thinking this is too complicated or that it doesn't apply to you. That's exactly how people miss out on thousands of dollars. The IRS isn't going to send you a personalized memo telling you exactly how much EITC you qualify for. You have to understand the rules and claim it. Common reasons people miss out include simply not knowing about the EITC, incorrectly reporting their income either too high or too low for the sweet spot, misunderstanding who a qualifying child is, making errors with their filing status like married filing separately, or not having a valid Social Security number for themselves and all claimed children. Remember, everyone listed on Schedule EIT must have a valid SSN that was issued by the due date of the return, including extensions. No individual taxpayer identification number or ITIN will suffice for EITC purposes. So, here's what you must do now to prepare for 2026 and ensure you maximize your EITC. First, start tracking your income meticulously. Every paycheck, every gig payment, every dollar earned. Understand the difference between gross income and net income, especially if you're self-employed. Second, educate yourself on the qualifying child rules. If you have children, review those age, relationship, and residency tests today. Don't wait. If you have any doubts, resolve them now. Third, be mindful of your adjusted gross income throughout the year. As 2026 progresses, if you see your income approaching a phase-out limit based on projections, you might consider actions that reduce your AGI, such as contributing more to a traditional IRA or 401k, or increasing pre-tax deductions through your employer. Fourth, understand the investment income limit. If you have significant investment activity, keep an eye on that roughly $12,000 threshold for 2026. Fifth, always consider professional help. While I'm giving you urgent, valuable advice, a qualified tax professional can provide personalized guidance tailored to your unique situation. But be an informed consumer, understand the basics so you can ask the right questions and verify their advice. Here is the reality. The Earned Income Tax Credit is one of the most powerful tools available to working Americans. It's designed to put money back into your pocket, but like any powerful tool, it requires understanding and careful handling. By taking the time now to grasp the projected limits and tables for 2026, by understanding the mechanics of how it phases in and phases out, and by proactively planning your income and deductions, you are not just preparing for tax season, you are taking control of your financial future. I want to save you from the nightmare of realizing, too late, that you missed out on thousands of dollars that could have made a real difference in your life. This isn't just about taxes. It's about empowerment. It's about ensuring you get every single dollar you are entitled to. So, take this advice, absorb it, and start planning today. Your future self and your wallet will thank you.